Hello, how are you doing? It's Louis Yanis here. I wanted to ask you the question, is it time for you to graduate? Is it time for you to graduate from your current investment process or your current way that you're investing your portfolio? I remember when I was a kid, I had teachers that tried to teach me certain things, whether it be English or history. In particular, there was when I was in college, there was this one professor who was teaching American history, and his method for teaching American history was very cookie cutter. He just spouted out a bunch of dates and told you, certain topics in a very dry way. He never looked anybody in the eye. He never connected with anybody. And he never really made an adjustment for people's different learning styles. He always just kind of did it in a cookie cutter fashion. And what's amazing about it is almost everybody got C's and D's in his class because he didn't adapt his program the way that he taught so that people can connect with him and actually get the material. And that's a lot like how people are investing right now. A lot of people are investing, and see if this is you. They're buying a bunch of mutual funds, or they have exchange traded funds and they have them in their brokerage accounts, or they have them at their 401k at their company. And maybe you've changed companies and you're still invested in these funds, but those funds are packaged products that are made by firms on Wall Street, or investment management companies that invest everybody's money in these funds the same way. And then there's usually, you might have an advisor who will kind of blend these funds together. But what you're really getting is a cookie cutter approach. And a lot of people, and I'm going to explain why, are probably ready to graduate, and you might be ready to graduate from that approach. I would say, I don't know for sure what the numbers are, but it is a huge percentage of most people that are invested that way. So why bother? Who cares? Why does this matter? Well, what matters, this is important, is because if you're invested in the cookie cutter approach, you may be in a position where you have unnecessary fees, you have unnecessary taxes, and your plan is not customized necessarily to your situation. And you're missing out on a lot of what's called planning alpha. Alpha is kind of a fancy statistical term that's used to mean that you're doing better, because in return wise, after tax. So many people are paying these fund fees, they're paying commissions on top of advisory fees, and this lowers returns when you have that cookie cutter approach. So what I think people should graduate to is having your own private mutual fund for yourself, or I call it integrated investment management, where you own the securities directly. So instead of going through these packaged products, you own these stocks and bonds directly, and you trade them without commissions. So you're bypassing a lot of the layers of fees upon fees, and you don't pay additional fund expenses on top of them. So the other big part of this, especially if you are in a higher tax bracket, is when you have a private managed account, a separate managed account for you, you avoid unnecessary taxes. And let me explain that a little bit. So when you own the investments directly with sophisticated software, when you rebalance, you can have your investments managed in a way where you have institutional research, and you're leveraging a bunch of different like top quality managers that specialize in different areas, but you own those securities directly, and your taxes can be optimized based on your particular situation. So everybody has a different tax return. Everybody has a different situation in what they own right now. So if you have your account set up in a way, you could have it to where you avoid short-term capital gains that are unnecessary. When you have a mutual fund, you can't do that. It's just distributed to you, end of story. Or even an exchange traded fund. You also, there's tax loss harvesting that can be done. So whenever there's a change that needs to be made in a portfolio, your specific situation can be looked at and said, okay, how can we make this change with the least amount of taxes or no changes, and offset losses against gains if necessary, and replace them with similar securities. You can also have household rebalancing, which is a big deal. So looking across all of your different accounts, you might have an IRA, you might have a regular account, you may have various different accounts, maybe a trust account. And if you have it set up in a way that you are having a private wealth management done, like we do at my firm, we're able to actually go across those accounts and say, okay, what's the best way for us to make the investment choices? What is the location that we should have certain assets so that we minimize taxes? And people think, well, that's not a big deal. Well, you know what? That generally adds up. Vanguard did an amazing study on this, and they found that it's well over a full percentage point difference if you actually do household rebalancing and have tax loss harvesting. So over time, that adds up to a ton of money. So you just take $1 million account, $500,000 account, $100,000 account, take 1% on that, and then you compound that over time. It's a big deal. And that's on the low side of the estimate. So it really makes a big difference. Another thing is a lot of people are paying a lot of unnecessary taxes. They're paying phantom tax. Phantom tax is something that I think a lot of people don't really know what it is, but it's very real. So like when you buy a mutual fund, you basically pool all your money into this fund with a lot of other investors, and the portfolio manager, he's making decisions, or she's making decisions based on the whole pool. So let's say the portfolio manager bought Coca-Cola, for example, and let's say he bought it at 50, and then Coca-Cola's price went up a little bit, right? Let's say it went up to 60, right? And then you bought into the fund. Well, when you bought into the fund at that time, you effectively bought that fund when Coca-Cola was at 60. Let's say you had a gain on that, and the portfolio manager took the gain, but you could actually have a loss, but get distributed out gains. I know that sounds kind of counterintuitive, but it is very common. You can have unnecessary capital gains from this phantom tax, if you will, because these gains are built up. They realize those gains. You may not have even realized those gains, but you pay taxes on them. That doesn't happen when you own the securities directly. So another thing that's really important about graduating, we're talking about graduating away from the old way of doing it and going into this way of integrated wealth management, your private mutual fund, where you own these stocks and bonds directly. It's professionally managed. You have institutional leverage research. The thing that's really important is that you can also have your portfolio customized to your situation. So let's say you have a concentrated stock position. Let's say you work for a company and you have built up some stock and you need to get rid of some of that stock. Maybe you need to diversify out of it a little bit. Well, you might have gains there. How do you manage those gains? Well, when you have this, really sophisticated software that can optimize your taxes, there's ways that rebalancing can get done so that you don't have such a big tax bill. That adds up to a ton of money you put right in your pocket. I had a professor when I was in college. He used to say, he was an economics professor. He used to call it the green in the genes. How much green in the genes have you added to your portfolio? It really adds up to a lot. Another thing could be like preferences, never buys and never sells. Like there might be a security that you never want to sell for whatever reason, or maybe you work for a company that won't let you buy energy stocks, and you can set it up to where you never buy energy stocks. So all in all, this adds up to a big benefit, and you can graduate from being kind of the training wheels of doing things the way 90% of people are doing things, and doing it the way that really the wealthy do it, and really the sophisticated people do it, because it makes a big difference. It helps you. It makes sense to leverage that for a lot of people. So you can customize your asset allocation. It's customized to your time horizon, how much liquidity you need, how much income you need, your growth needs. So I bring this all up because I see it over and over and over again. So many people need to graduate. So what you could do now is go over to my website, wealthnetinvest.com, and there's a button on the top, and just click that button, schedule a call. We'll do a free analysis to see if it makes sense for you to graduate. Maybe it doesn't make sense. Not everybody should graduate, but a lot of people should. And if you're in that position, you should call. And the website again is wealthnetinvest.com. We'll put it here. See if it comes up. All right, you guys, that's what I wanted to talk about today. I really want to educate people as to the difference between having a cookie cutter approach to having real wealth integrated management. All right. You guys have a great day, and I will talk to you later. I got to go get a passport picture. Bye.